crypto is having quite the moment.
Today, Bitcoin climbs as investors focus on when...
But I defend your right to smoke. I defend your right to buy Bitcoin. Go at it.
Donald Trump has said he wants to make America the crypto capital of the planet. One of the things
But there's one part of the crypto ecosystem that's garnering most of the attention. That's stablecoins.
Stablecoins are kind of a halfway point between official banking and the crypto sphere.
The stablecoin industry has matured significantly over the past few years.
For a stablecoin.
Stablecoins.
They're a crucial part of the cryptocurrency market. And they're about to enter the mainstream. But what exactly are they? And what are their potential risks? Let's try and find out. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, stablecoins. I'm your host, Carmel Crimmins in Dublin. Okay, so I think most people have heard of Bitcoin. And if you haven't, we have a whole pod on crypto, so go check it out. But stablecoins have flown more under the radar, until this year. That's because the US Senate recently passed legislation setting up rules for stablecoins. And if that legislation does become law, it's expected to fuel a further explosion in their popularity, allowing American companies to issue their own currencies. But before we get into that, what exactly is a stablecoin? Well, you know the way that Bitcoin and most other cryptocurrencies bound around in value? A stablecoin is designed to keep a constant value. It's usually pegged to a traditional currency, mainly the US dollar, at a 1-for-1 exchange rate. Most stablecoin issuers say they hold cash or government bonds to match the value of the stablecoin in circulation, to keep its value constant. The legislation under consideration in the US wants to lock that in, requiring dollar-pegged stablecoins to hold dollar-for-dollar reserves in short-term government debt or other types of assets. Proponents hope the legislation will turn stablecoins into a mainstream form of payment and provide a ready market for US treasuries at a time when the government is hiking borrowing. Standard Chartered estimates the stablecoin market could reach $2 trillion by 2028, from around $256 billion right now, if the bill is passed. But critics say stablecoins are risky. They point to their popularity with criminals who use them for money laundering and cyber fraud. And they argue that tying the treasury market to stablecoins could make that market vulnerable to volatility. The Bank for International Settlements, often referred to as the central banker's central bank, is one institution warning of stablecoins risks. So for this week's episode, I spoke to Hyun Song Shin. He's economic advisor and head of the Monetary and Economic Department at the Bank for International Settlements. Welcome to Reuters Econ World, Hyun.
Hi, Carmel.
So let's get straight to it. Do stablecoins' entry into the mainstream worry you, like coming from the world of central banking?
Well, I think, like all technology, whether it worries us or not depends on how it's used and, how that would actually affect our monetary and financial system, that it actually serves society.
But the US is looking to bring stablecoins into the mainstream with this legislation in Congress. What about if that becomes law?
Well, I think, let me answer more broadly because, the US is not the only jurisdiction that has regulations on stablecoins. In fact, the European Union was actually several years ahead of the US through its MiCA regulation. And the regulation is of the form, look, make sure that the backing is solid, make sure that we have the usual compliance requirements against anti-money laundering and other illicit activities.
Yeah.
So I think it's important to separate the rules governing those with the way that an instrument is actually used. Now, because of the fact that stablecoins are mainly circulating in the public blockchain, there are fewer controls in how it's transferred. So, in the whole point of Bitcoin was that you didn't need trusted intermediaries. You can just have your own wallet, your unhosted wallet,
Yeah.
and then you can transfer as long as you know the public key of the recipient, the address, if you like. And so in that sense, once you have a stable coin, there is an alternative system where value flows. And so if you're a country that relies on very stringent foreign exchange regulation, for example, well, then those regulations are going to be much more difficult to enforce if the residents in your economy are using stablecoins to transfer value. And this is definitely something that has happened over the last few years, that in emerging markets in particular, the users have taken to stablecoins as a way to gain access to a dollar means of payment. And here the context is that about 99% of the value of stablecoins are in those that are denominated in the US dollar.
Right.
And so definitely it's going to change the way that the global economy is connected. We know that the global financial system was already very highly connected, but what this is going to mean is that it's going to be even more highly connected, and relying on regulations, foreign exchange rules, for example, to curtail that kind of activity is going to be more challenging going forward.
Right. You mentioned the dollar there. Certainly with the plans in the US, as envisaged, stablecoin would strengthen the dollar's position in the financial system. Most of the stablecoins are backed by the dollar, and it would require those assets to be backed by treasury bills. So that would have some implications, right?
Yeah, I think the role of the dollar in the era of stablecoins, I think time will tell how much that actually transpires. I don't think it's a foregone conclusion that just because stablecoins become more widely used, that the currency that's underpinning it is also going to be more prevalent.
Oh, interesting.
There are various measures of the prevalence of currencies.
Yeah.
One is about reserve holdings. Another one is trade invoicing or financial flows and so on. I think with stablecoins, it very much live in the crypto universe.
Right.
And certainly as long as crypto is a very important focal point for money inflows, stablecoins will continue to have a role. But what we believe here is that we should also think about what stablecoins do not have. And that actually gives a clue in answering your question, what role that they will eventually have. Now, one of the things that we put a great store by in the past is the singleness of money. The fact that whatever form of money we use, whether you use a bank transfer or a phone app, or even cash, money is accepted at par without any question.
No questions asked.
And it's perfectly at par. Yeah, so no questions asked. Stablecoins have an exchange rate, and they have the name of the issuer attached to it. So it's like saying, when I wake up and open my phone, I have not only $30, but 10 red dollars, 10 blue dollars, 10 white dollars.
Yeah.
So they're different issues, and therefore they're different assets. And what that means is that there's always an exchange rate. However small a deviation it is from par, there is always an exchange rate. And in that sense, it looks more like a financial asset rather than money.
Right.
But I think the crucial point is that the way that the current system has evolved, especially for large value payments, is that our current system combines a credit function together with a payment function. And what that means in particular is that when I need to pay someone, but actually I have the money coming in tomorrow rather than today, I can actually draw on my overdraft and pay that bill right away, without waiting for the incoming payment. And so this is a very characteristic feature of the current system, because banks are very much at the heart of the system. And what that means is that when you have this very complex interlocking set of claims and obligations, you can actually avoid gridlock. And that's very, very important in large value commercial transactions. Whereas in stablecoins, as you know, you need the reserves to back it. And so you cannot create stable coins as the user, right?
Right.
You have to purchase more and then use it. It's what economists call a cash in advance constraint.
Right.
If you don't have the cash, you cannot actually pay using it. So for large value payments that are the backbone of modern commercial transactions, stablecoins really don't come across as being terribly useful. So I think time will tell what the place of stablecoins will be once the use in the crypto system becomes clearer. But I think it's an open question as to how much there will be use of stablecoins beyond its role as the gateway to the crypto ecosystem.
Stablecoins right now are mainly used by crypto investors to trade other cryptocurrencies or to park their profits, but they are catching on in the real world too. They're used by people to transfer money abroad, to sidestep high fees and delays in the regular international banking system. And in countries where inflation erodes savings, they're catching on as a store of value. Like in Turkey, where my colleague Ezgi Erkoyun spoke to people who invest in stablecoins.
Igor Barakovsky is an online entrepreneur and an expat living in the southern Turkish town of Kaş. He told me he started buying stablecoins years ago, before inflation really took off in Turkey. He finds them a good hedge against inflation.
The prices in Turkey, they increased, I think, 4 times since 2021. And I remember buying chai for 3 liras, and now the same chai with the same taste costs like 20 liras. So yeah, like my practice of buying stable coins happened quite a while ago, and I can see only benefits about this strategy.
He also finds them an easier and cheaper way to send money overseas than using the traditional banking sector.
Last week, I had a drama of sending a SWIFT transaction from Turkey to Georgia, and it's a bit complicated. Whereas keeping your stable coins, let's say on Binance or any other exchange, is really a better solution, because transactions are really much faster. This is first. Second, the rates with which you can exchange your stable coins back to liras, they are much lower than in the bank. So for me, as an expat in Turkey, I see that this is the only solution of saving my assets, saving my money, and making sure that the purchasing power of my money is being kept.
But Hyun, we are seeing banks wanting a piece of the action, right? And there is a risk there, isn't there, in linkages between stablecoins and the banking system, and that potentially causing trouble down the line.
Well, currently there are pretty stringent standards on how banks treat crypto. In fact, the Basel Committee, which is in our building, issued a set of standards at the end of 22.
Yeah.
Where basically if you have something which is circulating on the public blockchain on your assets, then basically that deducts from your capital. That's a very stringent capital treatment. And that dissuaded the banks from really getting into this business in a big way. But you can certainly envisage the bank setting up some separate legal entities that are separate from the main bank. And they would be like other, stablecoin issuers. But I think the point of contact will be fairly limited in that case. But certainly you're right that we have to watch very carefully for these points of contact and how easily it would be for one to transition from one world to the other.
And also, I suppose, the risk of, financial instability, that if there was a run on a stable coin, that could flow into the treasury market, that could cause instability elsewhere in the system, right?
I think that's a very good point, Carmel. And in fact, we published a paper recently that looked at the price impact on short-term government instruments.
Yeah.
From inflows and outflows from stablecoins. And there is definitely an effect there. So inflows tend to raise the price of these instruments and lower the yield, and vice versa. But interestingly, as you hint, it's the outflow that tend to have a much bigger impact on those yields. So when there's an outflow, the increase in yields tends to be 2 or 3 times larger than the decrease in yields when there's an inflow. It used to be the case that we repeated the conclusion that a crypto is too small to really pose financial stability risks.
Yeah.
Still fairly small.
Right.
I think it's probably something to watch rather than to ring the alarm bells. But certainly we're getting to a stage where stablecoins in the crypto world is having an impact on the conventional monetary system. So this is something that we have to be watching very carefully.
You mentioned the Basel Committee there. And so for listeners who aren't familiar with that, it's the body that develops standards for banking regulation. So Hyun, are central banks actively gaming out and looking at how they can protect against like the risk of financial instability from the rise of stablecoins?
The answer is yes, absolutely. And the BIS is very much part of that discussion among the central banks.
Yeah.
I think we have to broaden it out, Carmel,
Mm-hmm.
from simply the financial stability dimension to just broadly the monetary policy dimension as well. Because when we have these types of flows across borders, some economies, especially emerging markets, would have foreign exchange regulation, capital controls, both for inflows and outflows sometimes. And, they've been relying on that as a complementary measure to give them a little bit more space in monetary policy conduct. But, when these inflows and outflows are much harder to control, then the monetary policy operations will also need to take that into account. So it's not simply financial stability. It's also about monetary policy, meeting your monetary policy mandate as well. So, how much traction do you have as a central bank?
Right.
So, yes, we are, in discussions, and central banks are acutely aware of this. This is very much part of their thinking. How will the system evolve?
Could you give us an example of how stablecoins might impact monetary policy?
Say that you're an emerging market central bank.
Yeah.
You want to raise rates to arrest inflation.
Okay.
But it could be that, there's a demand and there are sort of, money inflows into the economy, both from residents and non-residents using the blockchain, using the public blockchain.
Yeah.
And that could somehow frustrate the objectives of the central bank in raising rates. Because, if you increase the money supply more generally, that has an impact on the market interest rates, in general. So I think that's probably where the biggest impacts will be felt.
Is the solution in terms of the risk factor to regulate the stablecoin issuers as if they're banks? Or like to bring them into the regulatory system?
I think the debate is all about, how they should be regulated.
Yeah.
The fact that a lot of the stablecoins circulate in the public blockchain means that it's difficult to apply the same regulation as for banks to, these kinds of intermediaries.
Right.
Because, we often repeat this principle, same risks, same regulation.
Mm-hmm.
But actually, in some respects, this is an empty statement because they don't have the same risks.
Yeah.
In which case, the same regulation part is, doesn't have any bite.
Right.
If there are different risks, then clearly you cannot apply the same regulation. And so I don't think bringing them into the banking sector, is the answer because, you really have no tools to regulate them as banks. So you don't have the same kinds of visibility on, how these things are traded and so on. So I think there is definite sense that whatever they may be, there are some, analogies with banks, but one big disanalogy is this elasticity that I was referring to, the ability to draw on your credit lines, draw on the overdraft.
Yeah.
That flexibility is really unique to banks.
Mm-hmm.
And it's what, puts the banking sector at the heart of the commercial payment universe. But stablecoins could bear some resemblance to money market funds in that, they also have reserves against the claims and have some kind of backing. But money market funds don't trade on the public blockchain, or at least the conventional ones don't. There are now new ones
Yes.
that are traded on the public blockchain.
Yeah.
And so I think when we look at the crypto systems, the conventional monetary system, conventional financial system, it's, there's a limit to how much we can take the regulatory standards we have for the conventional financial system and then just transfer those to the crypto ecosystem. Because having rules that have no means of being enforced would be, pointless.
Could you envisage a scenario where a stablecoin issuer has to be bailed out because there's, the implications for the financial system are so grave it needs to be rescued?
I think that's difficult to foresee, actually, Carmel, right now.
Okay.
But even if they were to become larger, I think it's difficult to foresee the central banks or the public authorities more generally having to come in and bail out the stablecoin holders. The only argument that I can see would be if there is some kind of systemic risk. So if there's a systemic risk, then this would be one argument. But even there, I think there's a limit to how large those systemic risks would be. I mean, the stablecoin sector, these are like tens or hundreds of billions of dollars, all told.
Yeah.
Whereas the conventional financial system is just much larger. And I think the key would be
begins with a T, trillions.
Yeah, absolutely. Tens of trillions.
Yeah.
And hundreds of trillions. So I think it's difficult to foresee, but I think if they were to grow much larger and they become somehow intertwined with the conventional financial system, then the potential for systemic risk, would also be higher. And so these kind of arguments may be raised at that point, but we're very far from that. I think on this, what I would say is it remains to be seen how large, this sector will become. They have grown on the back of the popularity of crypto.
Right.
Crypto has really taken off. It's become a new asset class, and stablecoins really are the gateway to the crypto universe. And that's in spite of the fact that, if you've ever tried to pay, using an unhosted wallet, let's say you want to transfer a stable coin, without an intermediary, without going through an exchange, you have to bid for that, right? You have to bid, you have to pay the gas fees, and you have to, pay enough gas fees that some, miner will come and package it and then put it into the next block. It's incredibly cumbersome to use that.
Yeah.
Whereas, if it's purely a payment purpose, the conventional system is just much more convenient and much more secure. So the fact that it's grown up in spite of that inconvenience in the unhosted wallets world, in that public blockchain, suggests that it's very much the crypto boom, which has really given stablecoin this big boost. So separate from that, I think it remains to be seen what eventual use stablecoins will have, separate from its gateway role to the crypto ecosystem.
A big thank you to Hyun for his time and insights, and to Ezgi Erkoyan for her reporting. You can catch all our coverage of crypto and stablecoins on the Reuters app and Reuters.com. Sound design, music composition, and engineering on this episode was by Alex Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Walljasper, Jonah Green, David Spencer, and Sharon Reich-Garson. Our executive producer is Lila de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.